Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is 1/8/2018 edition of Market Outlook. So things remain pretty much in gear after the election. Overall bullish scenario. Unemployment looks good. So overall economy not shaky. We always get concerned if employment data looks iffy, especially against a longer term or a 12-month moving average, and that is not the case. It's one of the better recession indicators. So overall, market in a good position, except there's a little issue with sentiment, which we'll get into. But let's start from the top. First of all, as you can see in the this first page here of Market Outlook and the market overview, is the strongest performer this week was NASDQ 100, led by FANG. And last year, or over the last 52 weeks, NASDQ 100 was one of the lagging key indices, and the Russells were the strongest. And over the last week, switched positions. Now, in terms of volume, nothing to report of significance. There's about an equal number of accumulation or distribution days, so nothing alarming or to report there. So again, overall, market performance looks good. This is quite the divergence from last year, where we really got tanked the first couple of weeks of the year, and the first week was really one of the worst weeks ever out of the gate. This one is pretty decent. So now let's take a look at the sectors. And as you can see, over the last 6 months, you only have 4 sectors that are down. And those are the defensive ones. That's utilities, consumer staples, and healthcare. Those are more defensive type plays. So it's not surprising over the last 6 months they haven't participated in the rally, the post-Brexit and the post-election rally. But overall, you've got a nice movement in all of these sectors. And again, the top ones, financials, semis, technology, transportation, all did relatively well this week, with the exception of semiconductors. But overall, they've been really on fire as well. So again, nothing major in terms of deterioration, with the exception of retail, right? You had Macy's closing a lot of stores. You got a lot of iffy type information, fundamentals coming out in that retail sector, moved into a distribution phase. So that's something to watch. Obviously, retail consumer spending is 70% of the U.S. economy. We like to see that strong. So that is a bit disturbing, but again, considering the overall position, we're looking pretty good. Let's take a look at some more detail in what's been hot. And obviously, over the last 5 days, palladium and some metals actually did extremely well. So one of the best sectors for the week was XME as well, and so we got some, and driven by partly palladium and other industrial metals. So obviously the big gainers still are showing strength in the economy. You have nothing really amazing to report other than gold and the gold miners and those metal mining stocks doing pretty well, and gold really outpacing the S&P. The gold miners up 2.94%, with the S&P only up about 1.6% for the week. So gold outperforming, gold miners outperforming. A bit of caution there. Let's see what happens and how that continues to play out. But again, overall, NASDAQ, biotech, these were the big winners on Friday, and they all put in very nice weekly performance. Okay, let's take a look at, and we're going to do this a little bit quicker today. I'm going to focus mostly on what is the biggest concern out there at the moment, and this is volatility. This is a chart of the VIX down here with the Bollinger Band, and as you can see, it's sitting at around 11.3, right? That on an absolute level, and even going back historically, is really very, very low levels. And oftentimes, it's indicating a lot of complacency or irrational exuberance. Obviously, another little bit more on a thrust down would put that in an extreme territory. So we're very, very low, but on a shorter term basis, not that extreme. So that suggests possibly some more, but rather limited upside to the market, right? When sentiment is that strong, you can still get, continued movement, but it's going to be more incremental at the moment. So again, that's the biggest concern out there. Looking at the sentiment indicators, let's take a look at the next chart here. This is looking at the ratio of 1 month to 3 month volatility, another good sentiment indicator. And what is that showing? It's showing here that it's running pretty rich, but not extremely overbought. As you can see, when we got above the outside of the 10-day moving average over here and started rolling over, you got a minor sell-off, and now you're back into what I would call a moderately rich zone, but not super frothy, right? You got that up here. You did get that little sell-off. So you got some more room to move to the upside, but my guess is because of the levels that we're sitting at, the upside move may be limited in duration before somewhat of a correction. So again, overall market position, can't really argue, right? The 10, above the 50, above the 200, all of this looking good in the S&P and the key indices, with the exception of that volatility, which is at a pretty low level and not quite an extreme. So there you have it. All right, that's the overall market picture. Again, just stay tuned to a potential 2% move down from here. And if it can't hold that, if it does in fact fall off that 2%, it could snowball into something a little bit larger. On the other hand, right now things are in gear. So 2% correction, I don't have an issue. Anything much more beyond that, I'd be a little bit more concerned based on some of our overall momentum indicators, and of course the fact that sentiment is running so rich. Okay, hope this helps. Bye for now, and see you next week.